Hello investors, welcome to Simpli Stocks. If we go to screener and apply a few very simple filters, that PE ratio should be less than 30, market cap above 2500 crore and sales growth more than 15%. So if we apply these very simple filters, we will get a few businesses that first are growing at a good rate and second are also trading at good valuations. So in today's video, we will apply these very simple filters on screener, shortlist companies, and then out of those companies, we will study 8 good businesses. The intent here is that these companies have both good growth and attractive valuations. So they can be a good starting point for further study. But yes, keep in mind that this video is in no way a buy or sell recommendation on any of these businesses. Please keep this in mind. With that being said, let's get started. The first business we will study is Fiem Industries. Fiem is an auto ancillary business and it makes lighting systems like headlights, tail lights, indicators for two-wheelers. Apart from this, they also manufacture rear view mirrors and plastic molded parts. If we talk about their customers, they cater to almost all two-wheeler companies. But if you see here, on the right-hand side, TVS and Honda are their two largest customers. Both of them contribute about 28% each to Fiem's total sales. Then Yamaha and Suzuki are their other two big customers, contributing around 15% and 9% of business respectively. Fiem is debt-free and their return ratios are also quite good. You will see that ROE has been 21% and ROCE 28% in FY25. And you will notice that this business is also trading at quite good valuation at just 26 PE. What's happening in Fiem is that their LED lighting business is seeing very good growth. The market is shifting from halogen lights to LED lights because LED lights are better in many ways. Their lighting business is currently growing at around 20% rate and their rear view mirrors and plastic molded segments are growing at around 10% each. That is why if you read their transcript, you will see that in Q1, meaning in the months from April to June, their sales grew 13% compared to the last year. But as their LED lighting segment keeps becoming a larger part of their business, the company's growth rate will keep increasing. For example, the share of LED lighting in their total auto lighting business has now reached 64%. Their target is to grow their sales by 15 to 20% this year. And this year, monsoons have also been quite good. So two-wheeler manufacturers and auto ancillaries get a direct benefit from good monsoons because the demand for two-wheeler goes up in rural areas and tier 3 cities. So you can study Fiem on your own. The next business we will study is Pennar Industries. Pennar is in the business of making pre-engineered buildings or PEBs. PEBs are basically buildings that are made with steel instead of concrete. There is a steel frame or structure on which roof and walls are later fixed. PEBs are designed and manufactured in factory and then they are assembled and erected at the client site. For example, Delhi Airport's T3 terminal is a PEB. Similarly, Blue Star's AC manufacturing plant in Andhra Pradesh is also a PEB. Apart from this, if you see here, solar manufacturing plants and data centers can also be pre-engineered. The cost of making these is lower compared to conventional concrete buildings. At the same time, they get ready faster compared to concrete buildings. Right now, PEBs is a niche sector of around 20,000 crore rupees in size that is growing at a good 12% CAGR. Pennar recently started a new plant in Raebareli of UP from which we can expect a good sales growth ahead. In their Q1, their sales growth was 15% because there were some issues related to labor and staff. But management says that those issues are sorted now and in Q2, meaning in the months from July to September, you will see better numbers. Pennar is trading at a PE of 26 and Q2 can be a breakout quarter for them. So we may expect good growth going forward. So you should study this business as well. After Pennar, let us take a quick look at BLS International. BLS is in the business of providing visa processing and consular services. Their business comes from governments and embassies of different countries where they manage services like document verification, attestation, visa processing, passport renewal, and others. Outside the US, they have about 16 to 17% market share across the world. This year, they have also acquired 3 businesses, iData, Citizenship Invest, and Edifilis Solutions, which will help them to increase their market share and will also enable them to enter some new business segments. BLS is a service-based debt-free business. That's why you will see their return ratios are around 34 to 35%. That is very high. And this is a very cash-rich company, meaning most of their profit gets converted into cash and directly flows back into the business. For example, their market cap right now is about 15,000 crore rupees, and they have about 1100 crore rupees lying in cash right now. They can use this to buy more businesses in the future. And recently, they did spend about 1200 CR on acquisitions. Even after that, so much cash is there. Their management's target is to keep growing their sales and profits at 20 to 25% for the next 3 to 4 years. That will be a mix of organic and inorganic growth. So if we look at all of this together, 20 to 25% growth, such a cash-rich company, high return ratios, and also a market leader, then at a PE of 27, this is quite a good deal. Now, the fourth business we will study is SH Kelkar and Company. SH Kelkar makes aroma chemicals that go into skin and hair care products, perfumes, and household products. These chemicals provide fragrances and flavors, meaning SH Kelkar is a niche chemical business. In both their fragrances and flavor segments, around 60% of sales come from India. Within that, their flavors business is growing well on a small base. You will see that in Q1, it has grown 69%. In the fragrances segment, India's growth was good, around 15 to 16%, but in Europe, demand was slightly weak. However, even there, the market is recovering. And apart from that, they are also expanding and increasing their capacity in Maharashtra and Holland. Overall, this business is currently growing at a rate of 15%. Last year, one of their plants had a fire incident. So their Q1 FY25 was impacted and sales were lower. That is why screener might show you a slightly higher sales growth, but in reality, the sales growth is 15%. And still, these are very good numbers. They have said that from October this year, margins will improve going forward, and then from next year, we will see even more margin expansion happening in this company. Right now, their return ratios are low because of that fire in their Vashivali plant, but from this year, we will start seeing things improve. Right now, at a PE of 26 to 27, this can be a good recovery play. But I want to say one thing here. I do not have very deep expertise in chemical businesses. I am still learning. So while studying Kelkar, please be careful and understand everything yourself. And I know I keep saying this again and again and you don't listen. But still, as a humble request, if you are liking this video so far, do give me a thumbs up. Also, you can subscribe to our channel Simply Stocks, where we bring multiple such videos every week. Honestly, your likes and subscribes are our only motivation so that we keep bringing such high quality research to you for free. So do like this video and also subscribe to our channel. Coming back to our businesses, let's look at another chemical business, Deepak Fertilizers and Petrochemicals. Deepak is into manufacturing of industrial chemicals, fertilizers, and TAN, an explosive chemical used in mining. What happened with chemical companies is that after COVID-19, the next 2 to 3 years went very well for them because demand shifted from China to India. Indian chemical companies saw a flood of export orders. Then 2024 was quite volatile and there was pressure on margins. But now margins are stabilizing. And if you see here, Deepak is expanding its manufacturing capacity by adding 376,000 metric tons per annum TAN capacity and 450,000 metric tons concentrated and diluted nitric acid capacity. This is a very large capex. For this, Deepak is investing massive 4,650 crore rupees. Through this, the manufacturing capacity of these chemicals will increase by 50%. This capex will go live in March quarter of next year. So you can keep Deepak on your radar as well. This business is currently trading at a PE of less than 20. But here the risk you have to look at is that their Q2, meaning the September quarter, can be slightly weak or soft because due to monsoons, mining activity slows down and demand for TAN is generally low. So you have to watch out for that. But if you look at it from a slightly long-term outlook, this is a good business. The sixth business we will study is Nuvama Wealth. Nuvama provides several different services related to stock market, investments, etc. They have 3 to 4 businesses: wealth management, asset services, and capital markets. In the wealth management business, they provide investment and portfolio management services to millionaires, multimillionaires, and billionaires. The second big segment is capital markets, where they help companies to bring IPOs and assist them in raising funding. In the past few months, we have been in a bear market. So this segment has underperformed. This is a cyclical business segment. After this, the unique thing that has happened in Nuvama is their asset services business. This business is seeing very good growth. Asset services includes their custodian business. In this, what Nuvama does is that it safely stores funds of FIIs and DIIs, and then whatever transactions have to be carried out, they are done through Nuvama. Apart from this, they also do funds accounting and related activities. For all this, Nuvama charges a fee. This is a sticky, non-cyclical business, meaning you earn here every year, no matter how the market is. And once you onboard a FII or a DII, it stays with you for long term. So what has happened in the last 1 to 2 years is that Nuvama has progressed from a cyclical business to a non-cyclical business. But because of the Jane Street case, there is some negative sentiment around Nuvama. Jane Street is one of their clients. That's why this business has corrected and come down to a PE of 20 to 22. But the long-term outlook for wealth management sector is very strong. As you can see here, in the last 5 years, FII money has grown at a CAGR of 24% in India. Similarly, assets under custody of hedge funds and PMS have grown at 50% CAGR. Apart from this, the number of millionaires and billionaires in India is increasing rapidly, due to which the wealth management market will triple in the next 5 years. And the alternative investment market, meaning all investments outside the stock market, that market will grow 5 times in the next 10 years. So this is a very fast growing sector. You can keep Nuvama on your radar as well. For this company, Q2 results and management commentary will be two big triggers. Moving ahead, on 7th place, we again have an auto ancillary business by the name of Lumax Industries. This company also makes lighting systems, but while Fiem caters to two-wheelers, Lumax caters to car manufacturers. Among them, their largest customers are Motherson Sumi, Samvardhana Motherson, Honda, Mahindra and Mahindra, Tata Motors, and MG. Even in four-wheelers, the market is shifting towards premium fancy LED lights. For example, if you look at Mahindra or Tata's new EV models, they have very fancy ambient lighting. That's why there is very good growth here as well. So Lumax is also a 20% type growth business, trading at a PE of less than 30 right now. You can study this business on your own as well. This video is getting slightly long, so we won't spend too much time here. The 8th and final business on our list is Adani Ports and SEZ. While other Adani Group companies trade at slightly premium valuations in comparison, it trades at a low PE and also has a very strong model. You would already know that this company operates ports. For example, their port in Mundra, Gujarat is the largest port in India. Apart from this, they have many other ports as well. And Adani has acquired ports outside India too. Now see, whenever India has to export or import anything, ports are needed. And what happens is that as a country develops, its international trade increases. Imports increase because consumption rises. Similarly, exports also increase. We manufacture more and more and export them all over the world. Export those goods all over the world. So ports are a very integral business for a country's economy. Adani Ports model has been to acquire struggling ports and improve their operational efficiency. This business has grown at 17 to 20% CAGR over the last 5 to 10 years. Apart from this, they are also working across the entire international trade value chain, from running ships and vessels to loading, unloading cargo at ports, to having a distribution network of railways, warehouses, and trucks. APSEZ is currently trading at a PE of 27. It is a large cap company, and I believe it has the potential to keep growing at 15 to 20% for a long time. So you should definitely check it out as well. These were your 8 businesses. If you like this video, then do give me a thumbs up. Apart from that, you can also subscribe to our channel, Simpli Stocks. For us, your likes and subscribes are our only motivation, so that we keep bringing such high quality research videos for you every week. So do like this video and also subscribe to the channel. I'll see you in the next video. Happy investing.